We are live. What's going on? Happy Wednesday. I am a few minutes late here. This is the Lawron Ballard Show, where we talk about all things life, tax, and everything in between. So today we are going to jump right in. I want to talk about what's going on in the news. So if you all are aware, the first thing is first. Allegedly, we are in a peace treaty, a peace agreement with Iran. So last week I reported to you the fact that there was a potential for a waiver of the gas tax to help bring some of those prices down, but we may actually not need that at this point in time because of that happening. What else is going on in news? The Boston Globe recently released an article talking about how more than 40% of millennials and young adults are having their parents assist them with down payments. And so if you are one of those parents, you've got to consider whether or not there's any inheritance tax, estate gift tax that we need to consider when you are making those contributions to your child. And finally, I'm going to keep reminding you about this until the deadline comes. Last week, we talked about the Kwong ruling that made it illegal, according to the case, to charge failure to file and failure to pay penalties during the COVID emergency. And so if you have been hit with those penalties, then you should consider whether or not you have a Kwong case. And if you do, work with your CPA, your tax preparer, to go through the proper channels to make sure you file a claim. That does need to be filed by July 10th, and we will continue to bring that to your attention. So we have a wonderful show planned for you today. We are talking about the 3 C's, of how do you. So if you don't know me, I'm Lawron Ballard. I'm a CPA. I work with high net worth individuals, helping them put together a tax plan and a tax strategy that not only is going to help them now and for this tax season, but it's going to help them in the future. And there is a question that I get a lot of times from clients. They're kind of like, well, did you just pull these strategies out of a hat? Like, how did you know that this was appropriate for me? And so I'm going to pull back the curtain and show you the exact framework that I use to help make those decisions. I call it the 3 C's, and we are going to talk about that today. So the 3 C's, what are them? They are complexity, category, and capital. Complexity, category, and capital. Those are the 3 things that you need to consider when you are looking at a tax strategy to see if it works for you. So what is the first category is category. The first C is category. And when we are thinking about the category, what does that mean? There's 2 things that I look for when I am working with a client. I want to understand whether or not the tax strategy that I'm implementing is an ROI-based strategy, or is it a tax optimization strategy? Those are 2 very different things. Let me give you an example. Last week I believe we spoke about the Augusta rule. I think we might have touched on it. Regardless, the Augusta rule, very simply, what the Augusta rule is, it is that you can rent out your primary residence to your business for 14 days or less than 14 days, and you are able to take a deduction in your business, and you don't have to report the income as the rentor or the landlord. Nice little incentive for business owners. And you can also use it if for example, the World Cup is going on. If you wanted to rent out your house for a couple weeks because there was games being played near you, this would be a good way to do it. So you wouldn't have to report that income. Anyway, nevertheless, the Augusta rule is a tax optimization strategy. Why? because yes, it's going to lower your tax bill, but it is not going to give you money back. And sometimes when I am looking at a client, I don't just want them to have a reduction in their tax bill. I also am looking at their entire portfolio, and I'm saying I actually want them to also have a return on their investment. So if they're putting $100,000 into a strategy or $50,000 into an opportunity, then I want to understand, how can my client get the money back? So here is the converse of this. I had a client who was a physician. They invested in oil and gas last year. What happened with oil and gas? They were able to get the deduction in the year that they invested in the opportunity, but then they are also getting a return on investment. They will get their money back in approximately 24 to 36 months. That is a big difference. So it's one thing to get a tax savings. It's a whole nother thing to get a tax savings plus also get your money back. And here's the reason why this is important, because a lot of times clients don't think about this. They just kind of wanted to, they just want the write-off. I just want the write-off. I don't want to pay anything in taxes. If I can pay zero, I want to pay zero. They just want the write-off. But here's the thing. If you are not optimized for the future, if you are not optimized for economic downturn, where's the money going to come from when you can't work anymore? Whether it's in your business, whether it is in your W-2 job. If you can no longer work, where does the money come from? Therefore, we need to figure out how to create passive income streams. And how I think about tax strategy is not that I'm trying to just lower your tax bill for 2026. I'm also trying to help you activate and deploy that capital for the future. So that is the category when I'm thinking about doing a tax plan for a client. Then the next thing is complexity. Complexity. This is very straightforward. Complexity is how easy or how hard it is to understand a topic. If you are not able to grasp something, I think it was, now I'm forgetting his name. Everybody knows this man's name. The Berkshire Hathaway man. Oh my goodness. Warren Buffett. I believe it was Warren Buffett says that you do not invest in something if you can't understand it. And that, I live by that. If I can't understand it well enough to explain it to a client, and the client doesn't understand it well enough to invest their money into it, then we leave it alone. There is no reason in investing or using a strategy that you can't understand. Why? Because little do people realize, doesn't matter who you hire. Even if you hire somebody to file your taxes, ultimately, you as the taxpayer are responsible. Yes, if somebody does something wrong, they can be held liable. I am a CPA, and if I make a mistake based on the information and I'm shown to be negligent, I can be held responsible, but that taxpayer is also going to be held responsible. So it's not just the professional, it's also you as the taxpayer. So if my clients cannot understand the concept and the strategy, it's not appropriate for them. So we try to steer away from that. I do take time to introduce things like, we got to learn, we got to expose ourselves. We got to get a little bit more. We got to get a little bit more of learning. But if you don't understand it, it's best not to do it. The final category when we are thinking about how to do or selecting a tax strategy is that we got to understand the capital. So when we were talking about the category, I mentioned the Augusta rule. If you already own a primary residence and you got a spare bedroom that you want to rent, or an in-law suite that you want to rent out to make some cash during the World Cup, there is nothing more or less that you have to do or out money that you have to spend to get that up and running. You can just do it. Now, if I have a client who wants to invest in oil and gas, or I have a client who wants to put money into, donate money to a charity, or get in connected with and establish a donor advised fund, that's a different level of capital investment, number one. And number two, we have to understand, again, going through the other things, the complexity and the category, am I going to get an ROI? Here's the other thing that you need to realize. If there is a capital contribution, usually you also have to be at a certain income level. So I have clients who are small business owners, they make good money, but they're not at a certain level. So they probably would not be able to invest in some of the strategies that I have to present them. So that's all. Those are all things that we have to consider. So that is the teaching for today. So just to summarize, if you want to select a strategy and you're not sure if it's right, trying to distill through it, trying to figure out, should I even consider this? Should I present this to my CPA? Should I present this to my tax preparer? Just remember these three things. You want to understand, you need to know the category. They can work with you to help you understand that. So you want to understand the category, you want to understand the complexity, and then you want to understand the capital that you have to outlay. If you can assess those things, you will make better choices for yourself. And that's exactly what I use to make choices for my clients. So now I want to jump into a case study. Let me get myself positioned here. And I'm looking to my left because I've got people on TikTok. How you doing? Happy Wednesday. So glad that you're in the room. If you are in the room and you're enjoying yourself, if you could put some hearts on the screen, that would be amazing. I so appreciate you. So this is episode 2 of the Lawron Ballard Show. I'm really calling this the preseason because the show technically doesn't launch until July 1st. So we got a couple of weeks before we launch, but you got to get the reps in. You got to practice. Practice makes perfect, right? So this is the second episode. We started last week, and I thought I had this already ready, but I got it together now. I got it together now, y'all. All right. So here's the case study. We got some real numbers. I have a dentist making $2.8 million a year. They have a tax bill of $222,000. This is how we're able to get it to $0. Making $2.8 million, a dentist making $2.8 million. They are married with children. This is how we were able to get it down to 0. There's 3 strategies that got implemented. Number 1 was an accountable plan. This is essentially a plan that allows you to be reimbursed from the business for things that you pay for personally. So as a business owner, that can be things like your cell phone, a home office. There's a certain things that you have to put in place. So documentation for that, but that is absolutely a possibility to reimburse yourself from the business. The second thing is the Augusta rule. We just spoke about that. Renting out your primary residence to your business and being able to take that deduction. The final opportunity was equipment leasing. So this one I'm going to let you know, not everybody is going to like this one. Again, this is one of those strategies that they can be controversial, but essentially what you do is that you establish a business that rents out heavy commercial equipment. That equipment then is leased out and generates income to pay the debt on the equipment. From there, you are then able to generate losses, and those losses then are what you use to offset your W-2 income. And so for this business owner, they had business income of 2.6. They had some other taxable income, and then they were able to utilize equipment leasing, accountable plan that saved them a tax savings of $2,000. They used the Augusta rule that saved them $3,000. And then equipment leasing was doing the heavy lifting, and that saved them $250,000. And so they ended up getting a refund, even though they made $2.8 million. And this is where it's at, y'all. This is what it comes down to. And if you listen to what I said, that's only 3 strategies. That wasn't anything major. It was 2 very small ones that almost anybody can set up. That you do not have to be a multimillionaire to take advantage of the Augusta rule. You do not have to be a multimillionaire to take advantage of an accountable plan. The equipment leasing does require you to spend some money, but there's ways around that. There's other opportunities. So that's the case study for today. I want to give you another one, honestly. I'd like to do another industry. So that is the dentist. But if you are watching me live on YouTube or LinkedIn, you can put a comment. Let me know what other categories that you'd like to see a case study from. But let's see. I want to see if I have. Sorry, I'm getting a request for a co-host on TikTok. I appreciate you, but we're not going to do co-host right now. So let's see. I want to find a good one. Okay, so we'll do an IT consultant for this one. And for some people, this might be a better picture of where they're at financially. So this is an IT consultant. They are single, they're W-2 income. And the crazy thing about W-2 is that it can be very challenging to figure out strategies for W-2 income. Why? Because most of the tax code is written around business and the advantages that you can take from business. So when you're a W-2 employee, it becomes very challenging. But we were able to do some nice things for this W-2 employee, and they saved $43,000, which is pretty significant with a couple strategies. So this IT consultant made $537,000, and the 3 strategies were charitable financing. Charitable financing is really the main one. And so what is charitable financing? Essentially, with charitable financing, you are able to borrow money. We'll keep it very simple. You're able to borrow money, and then you use the borrowed money and donate to charity for a certain amount. And then you take the full deduction from the W-2 income for the amount that you donated that was borrowed, as opposed to what you took out. So you are able to increase the amount that you deduct with charitable financing. Pretty interesting. So that one was a savings of $330,000, which ended up being I'm sorry. The tax saving was 114,000. I misspoke. The ending balance that they owed was 43,000, but they saved 114,000 with charitable financing. So those are our two case studies for today. I want to now take some questions, trying to see if there's any questions on TikTok in regards to any tax questions, any accounting questions, any entrepreneurship questions. What you got for me? All right, so while I am waiting for those questions to come through on the chat, let me read the questions that I already have. We'll start going through that. So the first question is how do I know if a tax strategy is actually right for me? So we would go back to what we discussed today, which is the 3 C's. We want to understand the complexity. We want to understand the capital that you have to outlay to execute the strategy. And we want to know the category. So is it an ROI or is it a tax incentive only strategy? And based on your goals, based on what you've got going on in terms of your overall personal economy, that's how you can decide whether or not a tax strategy is actually right for you. But the biggest thing, if I was to boil that down, how do you know a tax strategy actually works for you? Do you understand it? And can you afford to execute it? Very simply. Question number 2. I get this question all the time. Should I create an LLC or an S Corp to save on taxes? Now, most of the time you hear people say you need an S Corp. That's how you save money on taxes. That is dependent on your goals. An S Corp isn't always the right answer. It depends on what you're trying to accomplish. An S Corp could be the answer. It could not be. So in a past life, I worked at a startup. It was I'm getting tongue-tied. It was a SaaS company, a tech startup, served as CFO for that company. They were originally an LLC, and almost immediately they had to change to a C Corp. Why? Because an LLC did not align with the goals for the business. So it needed to be changed. But it really depends on what your objective is. This is the thing that I want people to understand. Tax is just a part of the conversation. It is not the full conversation. So you should consider the tax implications of a decision, but that's not the only thing to consider. There's way more to that than that. If you have any questions, you can always send questions to questions@hilltownadvisors.com, and we will read them live on the show. Let's go to question number 3. What is the biggest mistake people make when trying to lower their taxes? That is a fantastic question. And the mistake that they make is that they try to lower it in April. My friends, my TikTok friends, my friends here, that's not going to work. The majority, and when I say the majority, I mean more than 50% of any of the tax planning strategies that you have access to become of none effect December 31st. On January 1 of a new year, all of those strategies are no longer available. So if you are worried about your tax bill, now is the time to work on that. You can't just expect a lower tax bill and you haven't been clear that you want that to be a priority. So That is the biggest tax. That's the biggest tax. That's the biggest mistake people make when trying to lower their taxes. Well, this was episode 2 of the Lawron Ballard Show. I want to thank you so much for joining us. It is always a privilege to be here to serve you. I want to let you know that if you need any support, you can always give us a shout here on LinkedIn, here on YouTube, or on TikTok. You are able to get in contact with us. And we are live every single Wednesday at 2:15 Eastern Standard Time to share some awesome information with you and help you be more financially literate, help you save on taxes. We want to help y'all. It's always a pleasure. All right. I will see you next week. Peace.